everything in Content Pro It's simple. All right. Are we live?
We're live.
Excellent. Hey, awesome. Welcome, guys. And welcome, team. Both of you guys here in the conference room, as well as remote, just joining us from wherever you are in the world. Let's see. We've got some people starting to join us, so that is cool. And I'm going to give people the opportunity to jump in and join us here, and we'll get started in just a minute. Today in this training, what we're going to do is we're going to kind of carry over from all of the things that we've been talking about leading up to today, which is a lot of been like structure and defining what a deal is and kind of running the numbers and understanding why you're investing in real estate. Last week we took a nice little sidebar and we talked in depth about a personal residence acquisition and how terms can come into play. And so this time what we're going to do is we're going to kind of go back to the investor world conversation a little bit deeper. And we're going to get away from the creative real estate, the terms deals, and we're going to go back to private money. Now, private money can be used in terms deals. Private money is used in terms deals a lot of the time. We're going to talk about how private money gets applied just in a straight cash offer transaction. We're going to talk about what private money is. We're going to talk about who private money lenders are. We're going to talk about why they want to work with you. We're going to take away the mysticism and the mystery of private lenders, especially if you've never either been a private lender or worked with a private lender before. You think that they're this untouchable thing and that they're really hard to work with and that they're hard to find and that they're hiding from you. Well, they're not hiding from you. They're in plain sight. And they're everywhere. And most people are not private lenders because they don't know what you guys know. They don't have access to what you guys have access to. They don't understand the opportunities that they have to be a private lender. So let's define it as we jump in. And let's see, I'm looking, we are starting to fill up. Trevor, how we doing? We're getting a little bit of a audience here. Is the pace of people jumping in still climbing? Is it slowing down a little bit? Should we start jumping into content here, or should we let people get with us?
Maybe let's give it just a couple more minutes.
Okay.
It's starting to ramp up now.
Awesome.
So a couple minutes and then let's dive in.
Awesome. So in the time that we're just letting people ramp up, because I can't see who's joining us live, and that would be super helpful for the future. I want to be able to see who's joining us live,
okay,
so that I can engage with people as they ask questions. Because for those of you guys that are on the team, you know this, you can ask questions as we go. For those of you joining us live and just sitting in on our team training, you guys can ask questions too. This is an open opportunity for you guys to ask us questions. And so what we're gonna dive into and talk about today is funding, how you fund your real estate deals. Okay, most people think that they've got to go save up a bunch of money to go invest in real estate, and the truth behind that is you don't need a dime. Actually, you don't need any money to invest in real estate. What you need is knowledge, relationships, and action. That's what you need. The knowledge here is either if you don't want to use your money or if you don't have any money. Both of those are legitimate. Okay? People get into real estate investing all the time that don't have any money. Others of us are active in real estate investing and we choose not to just use our own money. Okay, not using our own money allows us to do more. It allows us to scale. It allows us to grow. It allows us to be flexible. right? It allows us to stay liquid so that we can act on some other opportunity if we want to. And it allows us to give a private lender the opportunity to get involved with real estate that they otherwise wouldn't have. So what is a private lender? A private lender is an individual just like you and me. They just happen to have somehow saved up some cash, made some cash, sold a house, and cashed out the equity into cash, inherited some cash, maybe have been working for 30 years and their cash has grown. Their cash position could be in the bank. They could have cash in the bank. They could have money in the stock market. They could have money invested that they want to take out and invest in an alternative investment like real estate. Real estate is classified as an alternative investment. Okay, we've been all conditioned and taught to believe that the non-alternative, the mainstream investment is the stock market. Put your money in the stock market, invest in the stock market, invest in publicly traded companies, put your money in all of these big funds that then invest in the stock market. You've been taught this and conditioned this and told that that's the way you do it. Well, for most Americans, I'll just talk about Americans. Most Americans, not even counting most of the world, for most Americans, that's a crappy plan. That plan sucks. And yet it's what you're taught, it's what you're told, and the dutiful people that we are, we just go do, right? Well, I think that's a crappy idea. And so let's do something else. Alternative investment is real estate. Alternative investment is private lending. It's doing something different. So we talked about could have cash, could have money in the stock market that they could draw out, could have money in a retirement account. Okay, you can invest your retirement account in real estate. You take it from a traditional IRA or traditional 401k, and you convert it to a self-directed IRA or a self-directed 401k. When you do that, that money that's in that retirement account can be invested into real estate. So it can buy real estate, it can lend on real estate, it can buy options of real estate. It can do all sorts of things. Your IRA, your retirement account, as a separate entity, can do all sorts of custom investment stuff. Okay, so as you're thinking about who a private lender is John and Sally, just like you and me, that is out there that has a little bit of capital and they want to do something with it. They want a decent return on their money. Okay, John and Sally have generally been conditioned that the stock market is the place to put their money, and they don't know what else to do with their money. They've got it invested in funds, they've got it invested in stocks, they've got it invested in the market, and they don't know what else to do with it other than call their financial planner, talk to their banker, yada, 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 and do what they're told. And yet they're nervous about the stock market. They're nervous about the fact that the majority of their wealth is in the market and it's exposed. Maybe they've diversified, they've got domestic funds and they've got international funds and they've got higher risk and lower risk, and they've got funds that pay dividends and funds that are equity based, and they've got all these different diversification tools. But at the end of the day, their money's in the stock market and they're nervous about that. What an alternative investment in real estate means is you take your cash out of whatever you're traditionally doing, you invest it to purchase, repair, and hold real estate, and you secure your investment against that asset. Okay, so private lending, a lot of people have heard, if they've played around real estate at all, they've heard about or they've heard about asset-based lending. Okay, asset-based lending is what a hard money lender does. Now, sometimes you hear hard money lender and then the joke is Guido's going to shoot your kneecaps out, right? That's not really what a hard money lender is. A hard money lender is an asset-based lender that says, hey, the house is worth $100,000. You're buying it for $65,000. I'll lend you the $65,000 to acquire the property, even regardless of your credit score, regardless of how much cash you have, regardless of all of the other things. They're looking at the asset and saying, if you default, we're going to do a deed in lieu at the time of funding. I'm just going to record my deed in lieu. I'm going to take the house over and I'm going to go sell it and get my money back and take the profit. Okay. Now, hard money lenders, here's the thing. Hard money lenders, they're different than a private money lender. Hard money lenders are in the business of lending. So they might still want to look at your credit score. They may not use it as a qualification to give the loan, but they might want to look at your credit score. They might want to have you put some money into the deal, whether that means that they want you to fund construction and then they'll do a draw to reimburse you after it's been proven. They might want to have some skin in the game. They're going to charge points. So if they lent you $65,000, 1 point is $650. It's 1% of the loan amount. Most hard money lenders are lending at 3 to 5 points, depending on the price point of the purchase. You get over $100,000, and generally you're probably in that 3-point range. If you can find somebody that'll go under that $100,000 mark, they might be in that 5-point range. So, because they're looking to make money, they're putting the amount of effort that they have to put in to make a $65,000 loan versus a $200,000 loan is the same amount of effort. They just make more money when they can deploy their $200,000 more efficiently at with one amount of effort versus 3 times with a $65,000 effort. So they charge more the lower the loan amount. Okay. That's why they do that. Now, hard money lenders are in the business of lending, so they set the terms. Okay, they make the rules and you play by their rules. That's the value of a private money lender. A private money lender is not in the business of lending. So who makes the rules? We do. You do. And when I say who makes the rules, what do I mean by that? What I mean by that is the private lender, not hard money lender, private lender is in the business of relationship. They're not in the business of lending. So they don't know to lend their money secured against real estate unless you introduce them to the opportunity. Does that make sense? So let's take John and Sally, right? Everyday humans. And let's take you, who's learning to invest in real estate, ready to invest in real estate, wants to invest in real estate. John and Sally have $200,000. You have the desire to go buy rental property or buy your next fix and flip, right? They're frustrated with the market, and yet they don't know what else to do with their $200,000. You educate them and teach them, hey, have you ever thought about investing in real estate? Yeah, we have, but we don't want to deal with tenants and we don't want to deal with contractors. And we've heard that that's a hard way to make money, and it seems risky to us. We understand real estate and the value of it, but the work we would have to do, we'd probably screw it up. So they say, I don't want to buy real estate, to which you then respond, well, have you ever just thought of lending on real estate? What if you could just put your money into a real estate deal at a discount, right? With equity, let's say the house is worth $100,000 and you lent $65,000 or $70,000. So there was 30 to 35% equity, and your money was secured against the house. Have you ever thought about lending on real estate? Never thought about it. I didn't know that that opportunity existed. Now you're into a conversation. Okay, that's fundamentally why it works. Okay, here's what I'm going to tell you guys. Private lenders, well, let me ask this question. And if there's people commenting, comment. Give me your thoughts. But I'm going to ask you guys here in the conference room as well. What do you think people are looking for when it comes time to invest or to lend money? Are they looking for a high rate of return? Are they looking for security? What do you think a private lender is looking for?
It's not always a high return because they already have money. It's more about that security of just over time getting that recurring revenue, right?
Okay. Yep. Awesome insight. Yep. What else? Do you guys think? What do you guys think about what kind of an interest rate do you think you have to pay to get private money?
I mean, it kind of depends because I feel like most people have been brainwashed into thinking like these really, really low rates of return from their financial investments.
Okay. And so are they okay with low rates of return? Do they want higher rates of return? What do you think they're looking for?
I mean, isn't everyone looking for like higher is better?
How high?
I don't know. Wouldn't most people be happy with like single digit, mid single digits, 5, 6, 7%?
What if I offered you 15% on your money?
I would give you money.
You would?
If I was sure it would be secure, absolutely.
You would. So if I offered you 15% on your money, Angela, if I offered you 15% on your money, hey, I got this real estate deal, I'll pay you 15% on your money, what's your initial response?
Let's look at the contract.
Okay, let's look at the contract.
I like it in writing. Yeah.
I like it in writing.
What's
Okay.
the collateral?
It sounds and feels better than the stock market.
It sounds and feels better than the stock market.
Mhm.
Okay. You guys want to know what a private lender really thinks? What's the catch?
Yeah.
Yeah.
Their first thought is, what's the catch?
That's why she went straight to the contract. She's
Right,
like,
yeah,
give
right.
me-
That's right. What's the catch? Okay. If I offer you 15%, what's the catch? If I offer you 12%, what do you think there? Like if I offered you 22% on your money, what would you say?
Let's look at your references.
And how risky do you think that investment is if I offer you 22% on your money?
That would be having no knowledge coming in. I would be pretty nervous about that.
High risk or low risk?
I would think it's high risk.
Okay. So if I offer you 22% on your money, are you guys going to give me money?
I'd be curious about the time spent.
You'd be curious about it. Okay. Here's what I'll tell you. Most private lenders, they're not in the real estate business. They're not in alternative investments. They're even talking to you because you have a relationship with them. If you offer them 22% on their money, you're not getting their money. Most of the time, if you offer them 15% on their money, you're not getting their money. 12% starts to be a little bit more reasonable in some people's thought. 10% sounds doable. 9% sounds very realistic. 8% starts to sound safe. 7% sounds like, how could I lose? Like the mindset of what rate of return a person makes defines their perception of risk. So if they hear that an investment pays 22%, people automatically consider it high risk.
I actually did that. Like when we were talking, when he was bringing up 5, 6, 7, in my mind, I was just like, okay, like that's low risk. And then we started talking about 15, 20. Immediately, like I thought about
High risk.
higher risk.
Right.
Like just without even thinking, like I'm not even trying to give my money away.
Right.
I thought about that.
So the reason I'm spending time talking to you guys about this is because you have to understand the psychology of people. And so you can, like, hard money lenders, those people that are in the business of lending, they're going to charge points, right? So maybe 3 to 5 points. They're going to charge you a higher rate of return. They're in the business of lending, right? So they're not offering you, they're offering you capital in return for, you're going to pay a higher interest rate because it's an asset-based loan. So they're going to probably charge you 10, 12, 15%, again, depending on the loan amount, depending on your track record as an investor, your track record with them. There's a lot of little things, depending on your exit strategy, there's a lot of little things that can go into that pricing of that loan from a hard money perspective. When it comes to private money, you're jumping the other side, and you're thinking about the psychology of the person that doesn't do real estate, the person that doesn't do alternative investing, the person that hasn't thought about lending their money before secured against real estate. And so if you go in and say, hey, the hard money guys are charging me 12%, so I can pay 12%. You're putting yourself at an immediate disadvantage, because you're immediately setting a 12% expectation to a person that's not in the business of real estate or in the business of lending, and they immediately consider that a higher risk venture. So you have, even if you can pay it, even if you can pay 12%, even if you can pay 10%, even if you can pay 8%, you have to think about the psychology of the other person. Okay. Now, so that's the setup. And I'm looking up to see if there were any questions on our board. In your opinion, is the deal first or the private lender first? That's a really good question. And it's chicken and egg. It's 6 of one, half a dozen of the other. I would say do both at the same time and see which one comes first. You don't have to choose one or the other, because there are multiple exit strategies. If you get the deal first and it's a good deal that a private lender should lend on, a private lender should lend on a deal that has been bought at a discount. So if you've bought it at a discount, or if you've contracted on it, you've made the offer, they've accepted your offer, you're under contract at a discount, meaning a private lender should look at that deal and say, yeah, that's a good deal, I'll fund it. If you do the deal first and you don't have the private lender, you can always go sell that deal to another investor. You don't need to fund it yourself. Okay, if you're under contract and you've got a piece of paper that says, hey, this $100,000 house that I can buy for $65,000, that piece of paper has value. That contract has value, right? How much value does it have? What if Samantha, you had a contract for a house that was $65,000 was your purchase price. As is, it's worth $100,000. It needs $15,000 in repairs, and when it's done, it's worth $125,000. Okay, and it rents for $1,150 a month. How much value does the right to buy that house for $65,000 hold? Well, you have to think, what would I pay for it? Would I buy your contract for $5,000? Would I give you $5,000 for the right to buy that house for $65,000? Now I'm in at $70,000. I got to put $15,000 into it. I'm all in for $85,000, and it's worth $125,000 when I'm done. And it rents for $1,150 a month. I'd do that deal all day long, right? Why would I do that deal? Well, let's think about the rate of return on that deal. Let's assume that I'm going to buy that house and I'm going to rent it out. Okay? So I'm going to be all in after repairs I'm going to be all in $85,000, right? Because Sam, you got the house under contract. I'm going to buy the contract from you for $5,000 because for whatever reason, your funding fell through or your contractors aren't available or you're coming up, you're going on vacation and you don't have time to deal with it. There's all sorts of reasons why you would just sell that deal, stick $5,000 into hip pocket National Bank and move on to the next deal, right? And I'm looking for deals. So I would pay you $5,000 to buy your contract. When I buy your contract, I'm going to take that contract to the title company now and I'm going to close in your place and I'm going to own the house. So let's do the math. If I take my $1,150 rent and I want to buy for rent, I don't want to flip it. Okay. If I'm all in at 85 and it's worth 125, that's pretty easy math to figure out. Okay. I can sell it for 125 retail and let's just assume 10% cost of sale. So I'm going to be 112, 500 net after my cost of sale, real estate commissions, closing costs, holding costs, those kind of things, right? I'm going to assume I'm going to list it with a real estate agent and sell it retail. So 10% cost of sale, I'm buffering up a little bit. I'd always rather estimate a little high and come in better than come up short. So I sell it and I net to seller at closing $112,500. What am I all in at? I'm all in at 85. So 112,500 minus 85, $27,500 profit if I flip the house. Okay. But let's say I want to rent it. So what are we going to do? We're going to look at $1,150 rent times what? Remember what we talked about? Tim V.
Yeah.
Taxes, insurance, maintenance, management, and vacancy. Okay. So let's just estimate right now 30%. So multiply 1,150 times 0.7, 805 times 12 months. Get our annual rent, annual net rent. Divide it by the all-in position of $85,000, right? That's an 11.4% return. Or in real estate terms, we call it a cap rate. And again, I've said this before, cap rate doesn't exactly apply to single family houses, but it's the same math. It's the same formula. And so the cap rate on this single family house, and the reason I'm saying this is so that the longtime investors out there don't start sending me a bunch of messages and say cap rate shouldn't be used on single family houses. Been doing this 20 plus years. I get it. And guess what? It should, because it works. And it's a really good way to estimate how the deal is going to perform. Now I can compare that deal, 11.4%, against other deals. And I can say, should I put my money into this and get 11.4? This deal performs at 11.4%, 11.4 cap. I can put my money over here and, oh, that deal is only an 8 cap. I can put my money over there. That deal is a 15.2 cap. Now I get to ask the question about where's the best rate of return, but I have to balance that against risk. Oh, my 15.2% cap rate over here looks like a better rate of return on paper, but the neighborhood is pretty rough. So my, like Murphy, the real world is going to show up. And so my paper return is probably not going to be as high because my tenants are going to beat the house up. It's not going to be a $1,500 tenant turn. It's going to be a $4,500 tenant turn and yada, 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 right? And so, but this other one, it's an 8% cap, pretty low risk, but I want my money to perform better than that. So I look at my 11.4 and I say, hey, this is a good deal. I'm happy with this deal. Samantha was happy too because she found the deal. She put $5,000 in her pocket, right? I'm happy because I got a deal at 11.4 cap that's going to cash flow. So our net rent going into my hip pocket National Bank is $805 a month, right? 1150 times 0.7. Take out my 30% estimate And look, 30% is simply an estimate. When you're doing the analysis of an actual house, go to the tax records and look up what are the taxes, right? Figure out what is the management. Figure out what is my insurance going to truly cost. Like, figure those things out, because you could be in certain parts of, say, Florida on a stick-built house where insurance is going to be through the roof because it's Hurricane Alley and block construction is the de facto default. And so you've estimated block construction insurance, and all of a sudden you're ending up buying this house thinking that you're going to have a cash flow, and your insurance goes through the roof. Now that was an example of hurricane, right? Little things like that happen all over the country. There's little nuances. So figure out what is the true insurance cost of that house. Tim V, taxes, insurance, maintenance, management, vacancy. The two that you're guesstimating all the time is maintenance and vacancy, right? Those are your guesstimates. The others are pretty well known. Your property manager is going to charge you 10% property management fee. Your maintenance and your vacancy are your question marks. Okay, so you get down to your $805 a month net rent going into hip pocket National Bank. Okay, and remember, we're going all in here at $85,000. What if you borrowed from a private lender the full $85,000? What if you borrowed the full $85,000? What interest rate could you pay that lender?
So if it's an 11.4 cap, I mean, they're going to be nervous if you're giving them too high of a number. So I could tell them 3%.
So you got to do math, right? You got to do math to figure this out.
Okay.
So $805 is coming into hip pocket National Bank every month. I know, because, and you guys know, what's my minimum cash flow criteria, because I've told you.
On this type of house, 250, right?
$250 a door. Yep. So I'm not doing this deal unless I can take out all of my expenses, net cash flow, and net after debt service $250 a door. So on this single family house example, I'm going to take my 805 minus 250. That means I have $550 a month that I can pay the private lender. Make sense? Okay, so $550 a month that I can pay the private lender times 12 months is $6,660. Ooh, I would never offer that. That's terrible. 666, that's horrible. That house is going to burn down before insurance is bound. I guarantee it.
Just run away.
So we take the 550 or 550, whatever that number was, the 555 times 12 to get $6,660. That's the net interest, or that's the total interest you're paying the private lender. How much did they lend? $85,000 divided by $85,000 on an interest-only payment. You're paying them 7.8%. Okay, so 8%, 7.8% interest. Okay. Now, generally, on cash flowing deals, I mostly pay 7%. I mostly pay 7%. Okay. Some private lenders I pay 6 or 6.5%. Some I pay 7. Some I pay 7.5. And the difference is I'll pay the more. I can pay up to 7.8 on this house. And these are this is the type of deal I buy, right? I can pay up to 7.8%. So I will tier up to 7.5% that I'll pay my private lender. They get what they want, 7.5%. I get what I want, $250 a door cash flow with an equity position. And guess what else? Guess what else? How do they get the 7.5%? How do you think a private lender goes from 6% to 7% to 7.5%? What do you think it is?
Are you at?
How much money do they give me? The more money you give me, the higher interest I'll pay.
Okay.
Okay? You want to do one deal with me? I'll pay 6%. I might pay 7%, but I'll probably pay 6% if you want to do one deal with me. Okay? Is 6% a high risk interest rate? Does anybody think 6% is risky?
No.
Like, most people don't think it's risky. Obviously, interest rate doesn't define risk. The deal itself defines risk. And do you know what? Do you know where the biggest risk in a real estate deal comes? It comes from you, the operator. The biggest risk in a real estate deal comes from you, the operator. Because if you know how to evaluate a real estate deal, it's simple math. Like a sixth grader can do it, right? Literally a sixth grader can figure out real estate math. It's not hard. The biggest risk comes in you, the operator, evaluating it wrong, being too optimistic, overlooking the obvious things, underestimating repairs, not managing the contractor well, paying your contractor 50% up front because they say, I got to go buy materials, right? They're going to tell you that. Hey, this $15,000 construction budget, I got to get half up front. Guess what? That ain't going to happen. That's not how it works. Now, I have had contractors that I have long-term experience with, and I've got 3 houses I'm doing right now that I've got a contractor working on. I have a great relationship with him, which make a mental note, we got to pay him today. Okay. So,
Nice.
yes, we're going to get him paid today. So we are going to walk out of here and go pay him.
Big star.
I've done a lot of business with him. I've spent a lot of money with him. He's rehabbed a lot of houses for me. And so, am I more flexible with him than I am others? Yeah, because I have a history. He's never screwed me. I've never screwed him. He tells me what he needs. I pay him because I trust him. But that trust was earned over time. That trust was, hey, we did a deal and it went really well. We did another deal and, we had this little hiccup. We worked through it. We did this other deal and it really sucks. And he bailed me out. Like, he hooked me up, helped me out. He stepped up. Like, he didn't have to. He stepped up, bailed me out, helped me on some things, drive prices down for an unforeseen thing that I'm like, oh crap, but that's real estate, right? And if you don't have people skill to communicate with that contractor and say, hey man, how do I get out from underneath this, right? You as the operator are the greatest risk in a real estate deal. And so your private lender lending you the money, they have to know that you have the skills. Here's what a private lender says. And guys, while you're thinking about this, while you're listening to this, if you have questions, if you're out there in virtual land, if you have questions, ping me in the comments right now so that we queue up some questions. And for those of you guys, the team, if you guys have questions too, be writing them down, jotting them, because we'll talk through it. Here's what private lender says. Well, I'm going to answer that question after I go back to my math. I can pay up to 7.8%. If I pay up to 7.8%, the private lender gets how much? 555. I get how much? 250, right? Out of the net cash flow. But if I only pay 7%, what does that do to my cash flow?
Increases it for yourself.
It increases my cash flow. I pay 7%. Now I'm going to pay them $59.50 interest over the course of the year, divided by the $85,000 they lent. That's my 7%. Okay. 55.50 divided by 12 is $462.50. That's how much I'm going to pay them. Okay. 462.50 minus 805. My cash flow is now 342. So I went up $92 a month by paying 7%. But I want you guys to get this takeaway. Like, this is big. I don't just go and say, hey, private lender, how much do you want? Okay. You build the opportunity for them to plug into. They're doing real estate because of the relationship with you. Other than you, they don't do real estate. Okay. And so this is the important thing. It's about relationship. It's about their trust with you. So if I'm having a conversation with a private lender, here's how I generally start that conversation. I'll say something to the effect of, so Henry, hey, what I'd like to do over the next 30 minutes or so is two things. Number one, I want to address the elephant in the room. Like, guys, I'm telling you, this is how I start a conversation with a private lender. This is the first thing I say. Hey, I want to do two things in our conversation over the next 30 minutes. The first thing I want to do is I want to address the elephant in the room, and that is how you're going to lose your money. The second thing I want to do is I want to address all of the things we're going to do to mitigate that and reduce your risk. Does that sound like a fair approach to our conversation?
Yes.
Absolutely. So then I say, here's what I've learned, Henry. I've learned that private lenders that I've worked with for a long time, and in particular, private lenders that are just getting started and maybe doing real estate for their first time, private lending for their first time, they have one thing on their mind, and that is a return of their money over a return on their money. Does that kind of sound like what's going through your noodle right now? And I called your brain a noodle. That wasn't a slam on you in any way. Does that sound like what's going through your mind right now?
It does.
Because that's what's going through their mind.
Yeah.
They're thinking about, how am I going to lose my money? What are you not going to tell me that I should be smart enough to ask, but I don't even know to ask? So how am I going to lose my money? How am I going to get my money back? Right? If I give you my money and I do this deal, how do I get my money back? Private lenders want a return of their money before they want a return on their money. Okay? So if you can solve the return of their money, if you do one thing, if you lead with that conversation, number one, you have experience. You get it. Guys, I'm telling you, I've lent money. I'm telling you, this is how the private lender thinks. How am I going to get screwed in this deal? Is the borrower going to screw me? Is the house going to screw me? Is the city going to screw me? Is the contractor going to screw me? Who's going to screw me? That's what the private lender is thinking, even if they don't know to articulate that. If they're brand new to private lending, they don't know to articulate all of those risks. I'm telling you that from experience. They're just thinking, how do I lose my money? Because they don't even know all the risks. So the rest of the 30-minute conversation then is what? It's dropping down all of those risks and showing them how you mitigate against all of those concerns. That's what it's all about. And so how do you mitigate against those concerns? Well, Henry, one of the things that you're probably thinking is, what if I say, Rob, this sounds like a good deal. I'll do this deal with you. I'll do the $85,000 and I'm in. And what if I wire you the money, Rob, the $85,000, and you disappear to the Bahamas and I never see my cash again? What if you don't take my money and go do real estate with it? What if you steal my money and bounce, right? No problem. I know that's what you're thinking, so let me address that. Your money never comes to me. Your money goes straight to the title company. I'm not going to touch your money. When we close, you're going to wire the money straight to the title company with a letter that says, unless insurance is bound, unless title is clear, unless everything is good for closing, don't fund the purchase. So if everything isn't good, title, insurance, all of the docs signed, you're going to just get your money back. I'm not going to touch it. Okay? After all of that is good, then me as the borrower, I'm going to get that overage, right? I'm going to buy the house for $65,000. I've paid the wholesaler $5,000 for the right to buy it, and the $15,000 in construction repairs are going to be sent to me after closing. or at as part of the closing. So then your question is probably, what's going to happen with the $15,000 in repairs? Let me tell you how I work with contractors. Okay, I have relationships with contractors, and the expectation is set that they're going to do the work. I'm going to verify the work. I'm going to pay them after the work is done. I'm going to pay them for labor and materials. We're going to have a set fixed budget. Sometimes I'll buy the materials. Other times I'll let them buy the materials, and we operate off of a set fixed budget. And we pay them after I have reviewed scope, I've reviewed pictures, I've had somebody walk through and verify that work is done. That's when we pay. So your $15,000 at closing is going to come to me. It's going to go into our work in progress account, okay, our WIP account. And when the contractor starts the work, and generally here's how it works. Contractors, you know, they work week to week, paycheck to paycheck. And so generally they're going to do a week's worth of work, and we're going to try to get them paid on Friday. And why? Because we want them back on Monday. And then we're going to pay them on Friday because we want them back on Monday, which, Angela, is why we want to pay them on Friday.
Very familiar.
So we're that's how it works. And so we're going to just systematically go through these things and just talk them down. And so if you start the conversation with a private lender that says, number one, I understand how you're thinking. I understand the fear you have. I understand that you want your money back. You want a return of your money before you want a return on your money. Then you get to knocking down all of those risks and fears. And then what do? Then you say, so Henry, let me tell you what a typical deal looks like. Okay, because at this point, we haven't talked about this $85,000 deal in our private lender conversation. Let me tell you what a typical deal looks like. A typical deal that I borrow from a private lender lends anywhere between $75,000 and $100,000. That's a typical loan amount on a deal that I acquire. And so depending on whether you want to get started, Henry, with just one house, the way kind of our system works, the way I do it, it works better for me and it works better for our lenders, is I kind of bucket things into 3 tiers. If you want to do one house with us, if you want to do up to 3 houses with us, or if you want to do 3 houses or more than 3 houses with us. And so what that means is if you want to get started with $100,000 or less, we generally pay 6% interest only, and we pay it quarterly. Okay. Now that's our first tier, and that's our starter point where people get started. Our second tier, we pay 7% interest only. We pay you every single month. We pay you monthly off of that cash flow, and that is up to $300,000. So if you'll commit to doing 2 or 3 deals with us, so up to $300,000. We can get you into that second tier at 7%. Now, if you want to go above that and say, I like this, I feel good about it, and you want to go above and hit into our third tier, which most of our private lenders, if they don't start in our third tier, they end up in our third tier pretty quick. We pay 7.5%. We pay it monthly, and that would be committing to over $300,000 in private loans with us. Let me ask you this, Henry. Which tier do you see yourself in today?
The first one.
First tier.
Yeah.
Okay, awesome. So let's start there. We can absolutely start there. We can start in tier 1. So we pay 6%. Let me tell you the deal I've got right now. So I've got a house that rents when it's fixed up. It rents for $1,150 a month. I'm buying it and repairing it. I'm all in for $85,000. And when it's said and done, it'll be worth $120,000 to $125,000. So your loan amount is going to be $85,000.
Right, but in this situation, like you answered, I forgot his question. You either have this deal or you don't have this deal yet, right?
Yep.
It doesn't matter in this conversation, right?
It doesn't matter.
Yeah.
It doesn't matter. If I'm going to tell you, if I don't have the deal right now, I'm going to tell you this. I tell you what, I've always got deal flow that I'm analyzing. Right now, all of my deal flow is accounted for by another private lender who is committed to funding. I'll tell you what I will do. I will put you on the short list. I think I've got a couple of deals coming down the pipe in the next, if not 3 days, probably inside of a week. And I'll get those over to you. If you're committed, we'll get this thing rolling in the next week or less. Does that work for you? And you're going to say, absolutely. So going back to answering that question of chicken or the egg, that's how you handle it right there. And guess what? You can go line up all sorts of private money. And then what do you do? You go to all of the FreedomSoft users that are the guys out there finding deals every day, and you go buy a deal from them. Or you get signed up with FreedomSoft and you go find your own deal in 9 minutes, like we teach our users to go do, because now you've got funding, right? So you get plugged into that deal finding world and you go make it happen, because now you've got the funding, you've got the commitment. And I will tell you that as you do this more and more, you're going to get into more and more conversations, and you're going to oftentimes have people say, I see myself in tier 2 today. Tier 2 is the most common. And then you go from there. Now, if you're listening to this and you're investing in a higher price market where a deal doesn't get done for $100,000, then you have to adjust your tiers for what you're doing. Your tiers might be tier 1 is up to $200,000. Your tiers, if you're in Denver, your tiers might be tier 1 is up to $500,000, right? And tier 2 is up to $1 million, and tier 3 is over $1 million, right? So you have to adjust your tiers based on your market, but this is how it works. We've got a few minutes left. Let's dive into some questions. What do we got here?
One that I'm particular, just a little bit further up. How do we go out and find private lenders? Where do we look?
Yeah, good question. They're everywhere. Everywhere you go, you start talking about, hey, one of the things that every party you go to, every backyard you're in, everything you're at, people always say, hey, what do you do, right? And you can say, Angela can say, I am finance manager at a software company that serves real estate investors, and I also invest in real estate. Really? You invest in real estate? Yeah. And now you've got conversation going. Tell me about that. How do you do that? Well, here's how I do it. And then you educate and you introduce private lending to the conversation. That's how you do it. Now we can get specifically technical on okay, you can go to public records and you can go download the list of everybody that is already a private lender, right? You can and you can start talking to those people. You can skip trace them, you can give them a call, and you can say, hey, I see you lent $128,000 on 123 Main Street. Are you looking for additional private loan opportunities, right? And so private lending comes by letting people know what you do, okay? Now, I teach an entire process that I've taught. I haven't taught this now for a couple of years because I haven't wanted to, I guess. But I teach an 8-week class on how to go get $1 million in private money. And we've had a 94% success rate for the people that have gone through that 8-week program and followed the process and the steps. And I will tell you, it comes down to 2 primary things and then a lot of little details. But here's the 2 primary things. You have to be attractive to a private lender. Okay, number 1, you have to be attractive to a private lender. So you have to be seen as a deal finder. You have to be seen as somebody that goes out and is the deal guy or the deal gal. You have access to discounted real estate that they otherwise don't have access to, because all they know is to call a real estate agent, right? You are an investor that's going after off-market deals. You become interesting and you become conversational and you become attractive to them to dig deeper. The second thing you have to do is you have to become a teacher, and you have to teach them how it works. So if you become interesting and a teacher around private lending and real estate, you will raise a lot of capital. Now, the thing you want to do then is you want to be intentional about putting yourself into situations where you become interesting and a teacher. You have to be intentional about making that happen. And that's how conversations light up. What else we got up here, Trevor?
Angela actually had a pretty neat question. If you want to just sound off real quick.
Title companies.
Yep.
So if you create kind of relationships with those people,
Yep.
are they allowed, I guess, number one, and or would they be a good connection to help get me in touch with those private lenders?
They can be. What they'll typically do is if you're talking to a title company and you're asking, hey, who do you see that's funding a lot of deals? Typically that title company is going to be respectful of the investor that has the relationship. But there's certain times, like they will connect you to a hard money lender all day long. They're going to protect relationship. Although there are certain times where they might say, I tell you what, I've got somebody who might be interested in talking with you for whatever the situation is. Let me take your contact information and share with them. But generally, they're going to be that third party, and they're going to kind of protect the relationships that are there.
Cool. Then I've got another one from YouTube here. What is the lender's exit plan? When is principal returned?
Yeah, good question. Lender's exit plan is never. And here's what I mean by that. They don't want their money back. As soon as they start getting a return on their money and cash flow every month, people get addicted to cash flow. People get addicted to cash flow, and they don't want their money back. Here's how I structure my typical deal. And if I'm borrowing money from Samantha, I'm going to do a promissory note with her. That's my promise to pay. It says how much I owe her, what the terms are, what the interest rate is, when it's going to be paid back, if it's amortized or interest only, what I'm going to pay on a monthly basis, when is it due, what happens if I default, what happens if I pay late. Like all of those things are going to be in the promissory note. So the promissory note is between us. The title company is going to record a deed of trust to secure that loan against the house, right? And then the deed is going to transfer to me as the borrower, as the buyer/borrower. Okay. And so the exit plan of the lender, this is what I typically do. I say, hey, Samantha, here's what I want you to do. I want you to commit at least 24 months to me. Okay. After 24 months, if you want your money back, let me know. Give me a 6-month notice. Okay. Now you could do 12 months, but I typically don't do 12 months. I'd like to go 24. If somebody balks at me, I'll cut it down a little bit. Maybe I'll go 18, commit to me 18 months, and then give me a 6-month notice.
That's where my question comes in.
Hold on, let me finish my thought. So if we get out 18 months and you private lender tell me you want your money back, there's several ways I'll get you your money back. I'll sell the house to pay you off. I'll pay cash out of my pocket to pay you off. I'll refinance you with another private lender. I'll refinance you with a traditional bank, or there's other things, but there are multiple ways that you can pay that lender off. And the reason you ask for that time is if worst case scenario came to play and you had to sell the asset to pay the lender off, you've got that 6 months to get that sale done and complete and closed and pay them off. Okay. But I have never had a private lender come to me and force that equation, because once they start getting the cash flow, they get addicted to cash flow. What else we got?
So I guess that's where partially where my question comes. I said, in what situation would you look to just flip the private money deal versus rent out the property? So I guess one reason would be they back out of their deal and you're just going to go try to sell the property to pay off their private lending.
So let me ask, so in what situation would you just flip a private, what is a private money deal? Explain, what do you mean? Am I flipping the house?
Yeah, you're flipping the house. Just, is there any situation where the lender would just say, I don't want you to rent out the house, I just want it to just be flipped, and then we just pocket the money?
Yeah, so so you could work with a private lender, and you could, I've done this a lot. I've fixed and flipped hundreds and hundreds of houses, and I've done a lot with private lenders where I split the profits in some way. Now, it doesn't always mean that it's 50-50. Sometimes I pay them, short-term deals can pay higher interest rates than long-term deals, okay? Sometimes I'll pay a higher interest rate on a short-term fix and flip. Sometimes I'll defer all of that interest till when it closes. Sometimes I'll do a revenue share with the private lender when the deal sells and we both cash out. So you get to make the decision of, is this deal going to be a short-term deal or a long-term deal? And then you're going to go get the private money that fits your plan. Does that make sense?
It does, yeah.
So you're in control. Unlike a hard money lender sets the terms for you and they kind of force you into doing what you're going to do sometimes, with private money, you get to be in control of your play and your plan. What else we got, Trevor?
Cool. This is one that I think is great to end on. What programs do you teach?
I've taught a lot of stuff. I teach a lot of lead gen type courses. I've taught a lot of cash flow, how to build passive income courses. I teach a lot of courses on private money and private lending, like taking the stuff that we're talking about here today and then diving deeper into the specifics of execution on a step-by-step basis. And so I haven't taught that 8-week private money course in a number of years. I used to teach it twice a year. It's an 8-week course, and it's super fun to teach, and it's super fun to see people go out and do. I just haven't done it in a while.
Gotcha.
There were a couple others up there, weren't there?
Yeah, so we've got another one. This one's a bit of a rehash. If we're paying interest only, what's the plan to pay off the property free and clear? Yeah, so if you're paying interest only, maybe if your private lender is going to stick with you for 30 years, right? That's just a mindset expectation, because you could go with a private lender and you could go buy one house, another private lender, another house, then go back and get more money from the same private lender, a second deal. You could go build a little portfolio, 5, 6, 7, 8, 10 houses, and then you could go refinance that portfolio with a non-recourse loan. Okay, you could private money 10 times, and it's all interest only, so it's not paying down the principal. Then you package that into a portfolio and you refinance with a non-recourse portfolio amortized loan that pays down over time. And then what do you do with, now you own those 10 houses. What do? You get all the private money back. The expectation was set for 30 years. So what do? You take the 10 private lender loans and you go buy 10 more houses, and you do it again, and you do it again, and you do it again. Does that make sense? So that's the answer to that question. What are you laughing about?
Someone said props to Mike for always being awesome.
Mike's not even here, and he's still getting praised.
Yeah, I mean, I guess that is how I'm sure he's being awesome right now.
Somewhere it is. Yeah. Oh, man.
But we're at time right now, so.
All right, awesome. Well, excellent. Well, thank you guys. I hope this was helpful, and I hope you guys got a lot of value out of it. We'll see you next time.